Everyone loves the word compounding. It sounds magical, right? Like some secret potion the wealthy use to build their multi-million-dollar portfolios while sipping coffee in their mansions. But here's the problem. When most people try it, they get bored. The results look ridiculously small at the start. It feels like watching paint dry, except the paint is moving slower than a tortoise on a hot summer road. And that's where people quit. They check their stock portfolio after 6 months, see only a few extra dollars and say, "Forget it, this doesn't work. I'll just buy the new iPhone instead." But here's the catch. The very thing that looks slow at first is the same system that can explode your wealth later. Compounding is not a sprint. It's the marathon no one wants to train for. So today, we'll break down why compounding feels like a tortoise in the beginning, and more importantly, how to keep walking alongside it until one day it runs faster than a Tesla on autopilot. If you're ready to break through barriers and achieve greatness, hit that subscribe button. We're here to support your journey to success. Number 1. The math nobody wants to accept. Compounding feels painfully slow in the beginning because the numbers are tiny. Imagine investing $500 in an S&P 500 index fund that grows at 10% annually. After 1 year, you made just $50. That's a nice dinner, not a new life. This is where most people bail. They think, 50? That's nothing. I'll never get rich at this rate. What they forget is that compounding is a snowball rolling downhill. The first roll doesn't look impressive, but the longer you let it roll, the bigger it gets, until it's unstoppable. Now here's the fun part. Stick with the same $500 monthly contribution for 30 years, and suddenly that boring snowball becomes nearly $1 million. The difference isn't magic. It's simply time doing the heavy lifting. The tortoise phase is your price of admission. Just like entrepreneurs slog through early years with tiny sales, investors slog through early compounding with tiny growth. Accepting this truth is the first mindset shift. If it feels slow, it means you're doing it right. Number 2. Start with bigger building blocks. Here's the cheat code. The tortoise only feels unbearably slow if you start too small. Think about it. 10% growth on 100 is 10th ounce. That won't change your life. But 10% growth on $10,000 is $1,000, and suddenly you're smiling. So if you want compounding to feel less like a turtle and more like a confident jogger, raise your starting capital. That might mean aggressively saving for a year before investing, cutting back on luxuries, or redirecting bonuses straight into your stock portfolio. One engineer I knew saved $15,000 before touching the stock market. Instead of $50 in year 1 growth, he saw $1,500. That difference kept him motivated. By year 5, his account was growing faster than his salary. This isn't about needing to be rich to begin. It's about front-loading your future. Imagine planting a tree. If you start with a seed, you'll wait decades before it gives shade. But if you plant a sapling, you'll see results in half the time. Let's talk about why you shouldn't mess with your snowball once it starts rolling. Number 3. The invisible killer. Interruptions. Compounding has one enemy worse than market crashes: your own impatience. Every time you pull money out of your investments for short-term fun, you chop off future branches before they bear fruit. The tortoise doesn't just need time, it needs consistency. Interruptions reset the clock. Pulling out cash is like taking 2 steps forward, 1 step back. Sure, you had fun buying that car, but you also erased years of future compounding power. That's why wealthy investors treat their portfolios like sacred temples. They let dividends reinvest. They ignore market noise, and they don't check balances daily. Don't kill your compounding by constantly dipping into it. Protect it like oxygen, because once it's gone, rebuilding takes years. Number 4. Time is your richest asset. Here's the part schools forgot to emphasize. The earlier you start, the less effort you need. If a 25-year-old invests $300 monthly in index funds growing at 10%, by 55, they'll have nearly $600,000. But if they wait until 35 to start, they'll only have $200,000, even if they invest the same amount. The race looks unfair, but the earlier tortoise wins by simply starting sooner. Time multiplies your money without asking for overtime. Any college student I met started investing $50 monthly in a dividend-paying ETF at 19. By graduation, her account wasn't massive, but it was generating passive income. Her friends laughed until she used her dividends to cover half her rent while they were still broke. Ever say, "I'll start when I have more money"? The amount matters less than the clock. Every year you delay is wealth you'll never catch up on. But maybe you're already in your 30s, 40s, or even 50s. Don't panic. In the next section, I'll reveal how late starters can still hack the game. Number 5. The late starter's advantage. Here's the uncomfortable truth. If you start late, you don't get the luxury of waiting decades for compounding to do all the work. But here's the silver lining. You can compensate with higher contributions, smarter allocation, and income from assets beyond stocks. For example, investing $1,000 monthly at age 40 into growth stocks or rental properties can still turn into millions by retirement. The Tortoise isn't your only vehicle. You can add horses to your race, like building side hustles, owning real estate, or buying dividend stocks that throw off cash flow immediately. So if you're starting late, don't sulk. You just need to combine the slow tortoise of compounding with faster sprinters like business income or real estate cash flow. The combination still gets you across the finish line. Number 6. The silent enemy. Inflation. If compounding feels slow, inflation makes it feel like it's running backward. Imagine saving $10,000 in a bank account earning 2% while inflation is 6%. Every year, your money is actually shrinking in purchasing power. The tortoise is moving forward, but the track itself is sliding backward. That's why wealthy people avoid leaving cash idle. They park it in assets like real estate, bonds, or mutual funds where returns outpace inflation. Think of it this way. Your money has to run faster than inflation just to stand still. Only when it surpasses that hurdle does compounding truly shine. This is why dividend stocks, S&P 500 index funds, and even rental properties are powerful. They produce cash flow and growth that beat inflation. So the key is simple. Don't just save, invest. Savings accounts protect against emergencies, but they won't make you wealthy. Inflation ensures that. In the next section, I'll reveal why the richest investors actually love volatility in the stock market, while ordinary people fear it. Number 7. Volatility is your best friend. Most beginners panic when their stock portfolio drops 20%. They think compounding is broken. But the wealthy? They love those dips. Why? Because volatility is the discount season of the stock market. Imagine you're shopping for Tesla shares. Last month they were $250. Today they're $180s. The business hasn't disappeared. The price is just cheaper. If you're building long-term wealth, volatility is like buying assets on sale. The tortoise loves volatility because lower prices mean more reinvested dividends, more shares accumulated, and more fuel for future growth. One entrepreneur I knew called every market crash a net worth sale. While his friends sold in fear, he bought Nvidia stock when everyone else was panicking. 5 years later, his portfolio had doubled, not because he was lucky, but because he embraced volatility instead of running from it. Stop fearing market swings. Compounding is not broken when prices fall. In fact, it's speeding up quietly behind the scenes. Number 8. Automate the boring stuff. Compounding fails for most people not because the math doesn't work, but because humans get distracted. You forget to invest, you spend money impulsively, or you try to time the market. The fix? Automation. Set up automatic transfers from your paycheck into index funds, bonds, or dividend-paying ETFs. Once the money leaves your account, you can't spend it. You don't think, you don't negotiate, you just build. One small business owner automated $800 monthly into an IRA. 10 years later, he was shocked to see $150,000 sitting there. He admitted, "If I had to click buy every month, I would have spent half of it." Automation removes your worst enemy, yourself. It turns compounding from a choice into a system, and systems always beat motivation. But what if you still feel like progress is too slow? That's when you need the mindset hack I promised earlier. Number 9. Celebrate milestones, not millions. The tortoise is boring because you keep staring at the finish line. Waiting 30 years for $1 million sounds depressing. But waiting 6 months to celebrate your first $1,000 of stock market appreciation? That's exciting. Create checkpoints. Celebrate when your dividends can buy a nice dinner, when your portfolio covers your car insurance, when your rental property cash flow pays a utility bill. These milestones are proof that compounding is working, even if the numbers are still small. This is how marathon runners survive. They don't obsess over 26 miles, they celebrate every water station. You need the same mindset for investing. The key is not to obsess over millions. Obsess over momentum, because once momentum builds, the millions come as a side effect. Now let's close with the ultimate truth about compounding that separates the wealthy from everyone else. Number 10. The tortoise was always the winner. Here's the big reveal. Compounding is supposed to feel slow at first. That's the test. That's why most people fail. They can't handle the boredom. They want quick wins, IPO jackpots, hedge fund openings, or crypto rockets. But the ones who stay boring, who keep feeding their tortoise, those are the ones who end up with the empires. The wealthy didn't get there by chasing shortcuts. They built their portfolios patiently, letting stocks, bonds, real estate, and businesses compound quietly in the background while they lived their lives. And one day, the tortoise outran the hare. So here's your choice. Do you want excitement now and regret later, or boredom now and financial freedom later? Because here's the truth. The tortoise only looks slow if you're watching too closely. But if you trust it, give it time, and let it roll, you'll wake up one day shocked at how fast it's been running all along. So the next time you feel compounding is too slow, remember, that's exactly how it's supposed to feel. The boring path is the wealthy path. Automate, celebrate small wins, avoid interruptions, and let the tortoise do its job. If you got value from this, make sure to hit like, subscribe, and share this video with someone who needs a reminder that wealth is built step by step, not leap by leap. And keep this in mind, the tortoise always wins, but only if you let it finish the race. Now, if you want to know about why simplicity is the ultimate wealth strategy, then watch this video. I'll see you there.